Your income went up, your tax bill went up faster, nobody passed a new law. In New Zealand, the average worker paid 17 cents in every dollar as income tax in 2010. Today, that figure is 22 cents, the highest it has been since at least 1984. Here is what happened. When inflation pushes your nominal wages up, your income crosses into a higher tax bracket, or sits deeper inside the one you were already in. The government collects a larger percentage of your income. Your real purchasing power has not changed, but your tax bill has grown. No new law required. No vote, no announcement. The brackets sit where they were set. Inflation does the rest. This is called fiscal drag. It arrives dressed as a pay rise. The numbers from New Zealand's own Inland Revenue and Treasury make it concrete. In the year to June 2011, the median full-time worker earned $48,024 and paid $7,427 in income tax. By June 2023, that same worker earned $73,417 and paid $15,148. Nominal income rose 53%. The tax bill rose 104%. The tax bill more than doubled, while income barely kept pace with inflation. The government did not pass a new tax law. For 14 years, it simply did not adjust the brackets. In 2024, it finally did. Budget 2024 moved the thresholds for the first time since 2010. That adjustment handed back about a third of what had accumulated. Middle-income earners are still paying roughly $2 billion a year, more than they would be if the brackets had kept pace since 2010. The mechanism was not removed. It was reset to a lower starting point, and it began climbing again the day the new thresholds took effect. New Zealand is the case study because its own institutions documented it clearly. But this is not a New Zealand problem. The same arithmetic runs in Australia, the UK, Canada, and the United States. The numbers differ. The mechanism is identical. There is a third layer currently playing out in the United States. The Federal Reserve measures inflation using a metric called personal consumption expenditures. Kevin Warsh, the new Fed chair, has signaled he prefers a different version, one that strips out extreme price movements and produces a lower inflation reading. The preference arrives at the exact moment oil is up 60%, fertilizer up 20%, producer prices running at 6% annually, the hottest since 2022. Pick the gauge that reads lowest, and the case for easing writes itself. The Dallas Fed's trimmed mean currently reads 2.3%. The standard measure reads 3.3%. Harvard's Jason Furman has said publicly that the measure appears to have been chosen after the fact, because it gives the answer Warsh wants. This is the mechanism applied to the measurement itself. The government debases purchasing power. When the numbers become inconvenient, it considers changing how it measures debasement. The bracket creep continues regardless. Official inflation figures can be revised downward. Nominal wages keep rising, and the mechanism keeps running. Now, the full sequence is visible. You earn income, tax is taken, you spend what remains. Sales tax is taken, you save what is left. Inflation erodes it silently. Then inflation compensates you nominally, and the government taxes that compensation at a higher rate without passing a single new law. Sound money does not eliminate taxation. It removes the hidden mechanism that allows tax burdens to rise without democratic consent. When the unit of account holds its value, a tax increase has to arrive the only way it should, as a law, debated and voted on, with names attached to it. This is the Cantillon letter. Monetary truth. Understand it first. Subscribe and visit us at cantillonletter.substack.com.